So here's our game plan for today's explainer. We'll start with subsidiary versus principal books, then move into the strict recording rules, tackle a ledger practicum together, and finally finish up with a pop quiz to test your knowledge. All right, part 1, subsidiary versus principal books. This right here is where the magic of organization actually begins. What's really fascinating about this is how it establishes a clear timeline for our data. Look at the subsidiary books on the left. These are your books of original or prime entry. Honestly, just think of them as the starting line. When a transaction happens, boom, it lands here first. Then, over on the right, we have the principal books, like your ledger or cash book. These are the finish line. They take all that raw, perfectly categorized data from the subsidiary books and act as the final destination, which we then use to build our trial balance and financial statements. Now, instead of just one single starting line, we actually have several highly specific registers. We've got the purchases book, the sales book, registers for when goods are returned in or sent back out, and of course, books for bills receivable and payable. By splitting these up, we're doing the hard work of categorizing transactions right at the source. And let me tell you, that is the absolute secret to keeping our principal ledger from turning into a massive, unreadable pile of numbers. Now, you can't just throw any transaction into any random book. That brings us to part 2, the strict recording rules. I want you to start thinking of our subsidiary books like incredibly strict bouncers standing at the door of an exclusive VIP club. Here is the absolute most crucial point. The purchases book is exclusively, and I mean exclusively, for credit purchases of goods dealt in or materials used by the business. You really have to read that carefully. If you run a shoe store, this specific book is only for when you buy shoes on credit to resell to your customers. It's not for buying the display shelves. It's definitely not for paying your monthly electricity bill. It is only for the core trade goods your business actually deals in, and, this is key, only if you haven't paid for them yet. If a transaction doesn't meet those exact criteria, our bouncer turns it right away. Let's look at the exclusions. Let's say you paid cash for those shoes. The bouncer says, nope, you go to the cash book. What if you purchased a fixed asset, like a new delivery van or maybe some secondhand machinery? The bouncer says, absolutely not, you aren't trade goods, you're going to the journal proper. This strict, no-nonsense entry policy is what guarantees that the total sum of the purchases book genuinely reflects the core credit inventory flowing into your business. Okay, moving on to part 3, the ledger practicum. It is time to roll up our sleeves and actually process some raw data, just like the pros do. All right, take a look at this. Here is a purchases book in action. We've got 2 transactions here that successfully made it past our bouncer. First, on April 4th, we bought goods on credit from Balaji Traders. The goods cost $64,800 plus $150 for freight, bringing our total to $64,950. Then, a little later on April 15th, we did the exact same thing with Tripathi Industries, $30,600 in goods, $100 in freight, totaling $30,700. So our subsidiary book has perfectly captured the names, the dates, and the exact amounts. But how do we actually get this over to the finish line? Well, here's exactly how we post it to the principal ledger. Step 1. We go into the individual ledger accounts for Balaji Traders and Tripathi Industries. Because they supplied us with these goods and we currently owe them money, they're our trade payables, so we credit their respective accounts to show that liability. Make sense? Then, step 2, to complete our double entry system, we take that grand total right from the bottom of our purchases book for the period and we debit the overarching purchases account. That debit simply indicates the total receipt of goods into the business. And there you go, raw data beautifully transformed into a perfectly structured ledger entry. Which brings us to part 4, the pop quiz. All right, class, you've absorbed the theory, you've seen the practicum, now I'm going to throw a few rapid-fire scenarios at you to test your knowledge. Think fast. Question 1. True or false? Transactions regarding the purchase of a fixed asset are recorded in the purchase book. Think back to our incredibly strict bouncer at the door. What are his rules again? Does a fixed asset get inside the club? The answer is false. Excellent job if you nailed that one. Remember, the purchases book only allows credit purchases of trade goods inside. Fixed assets? Nope, they require a completely different entry method, which is usually right through the journal proper. Okay, next question. Let's flip things over to the revenue side for a second. True or false? Cash sales are recorded in the sales book. Come on, apply that exact same logic we just used for purchases, but in reverse. False again. Just like the purchases book is for credit purchases only, the sales book is strictly for credit sales.
If cash changes hands immediately, that transaction completely bypasses the sales book and goes straight over to the principal cash book.
All right, let's try a slightly trickier scenario. In which book of original entry will you record an allowance of $50 offered for an early payment of cash? Keep in mind this is a post-invoice adjustment, so where does it belong? Well, you'd actually record this in the cash book, usually in a specific discount column, or in the journal proper. See, an after-the-fact allowance for early payment just doesn't fit the strict criteria of those standard purchases or sales subsidiary books. All right, final question, and consider this your final exam for the day. Listen closely to this one. A second-hand motor car was purchased on credit from B Brothers for $10,000. Because it was purchased on credit, does it go in the purchases book?
A resounding no. Congratulations to everyone who caught that little trick. Even though the transaction was on credit, a motor car is an asset. It is definitely not the core trade goods the business deals in, so the bouncer stops it right at the door and it has to be recorded in the journal proper.
Listen, class, you did a phenomenal job today grasping these really vital concepts. But before I dismiss you, let me leave you with one final, kind of provocative thought. We know that subsidiary books are designed to flawlessly organize our data before it hits the ledger, right? But we're all human. What happens if an error is committed? Like if a mistake somehow sneaks past the bouncer and infects the principal books? How do we fix it without literally tearing up the entire ledger? Well, you'll just have to join me for our next explainer to uncover the fascinating world of rectification entries. Class dismissed, and keep on learning.